right, well, welcome everybody to this week's stock market review. My name is Bennett McDowell with traderscoach.com, and today is the 10th of July. I hope everybody's doing great out there and had a great July 4th. Great time of year, right? All right, a lot to cover today, and I want to get into the markets. The markets are, I think, making an attack now to its target range at the top, and so I kind of expected this. We're going to go over the charts. We had a breakout on the 60-minute Dow Jones chart. And basically, all the indexes, and we're going to go over those, are also breaking now to the upside. All right, so let me go full screen here. Give me a second, get organized, and then we will hit it. Okay, so audio visuals good. Keep me advised of that. Let's make sure that's working okay, and then let's go ahead and get going. All right, take a moment if you wouldn't mind, even if you're watching the recording, give us a like. All right, at this point, helps the channel, of course. Couple of announcements now. We're going to change things up a little bit. You know, we're doing a lot of day trading these days, and so we need to free up our mornings. And also, too, we have the market opportunity report that's available for detailed, in-depth analysis, even a lot more specific than what we do here. And so if you're interested in that, and that is a weekly service, you can subscribe to that, and we come out with the updates every Sunday. So that's very popular. So we're going to come out with a new market review schedule, which is this webinar. All right. And we're going to make it once a month. And it's going to be the first Wednesday of every month. And it's going to be 4:30 p.m. Pacific time. So later, okay, a little in the afternoon. And it's going to be here on the YouTube channel. So just a quick run over upcoming live market review dates on YouTube will be, the first one will be August 7th. So after today, the next one's going to be August 7th. So it's not going to be next week, okay? It's going to be August 7th. And then we hit September. It'll be on the 4th, and October the 2nd, and November the 6th, and December ending out the year on the 4th. So just remember, what you need to remember is after today, it's going to be the first Wednesday of every month. And it will be here on YouTube, and we will record it, of course. All right, so that's kind of, just mark that down. You can look at the recording again as well. All right, before we get into the content today, just a quick run over on the risks involved in trading. You need to be aware of them. There's no guarantees whether you position trade, invest, or day trade. It doesn't matter. There's no guarantees that you're going to make a profit. It is skill-based. All right, it's not easy, but doable, of course, and you have to have very strict risk control as well. And I've written a couple books on that I think will help you if you're kind of suffering in that area. The other thing, too, make sure you always fund your trading account with money you can afford to risk, called risk capital. I highly recommend prop firms for those day traders, and I'll cover that a little bit on the next slide. For day traders, use a prop firm, okay? Yes, they have rules. Yes, they have regulations, but they're doable, okay? And it will actually make you a better trader. And you can use their money to trade the markets. You got to get qualified, but it's a fun process, and they give you free data, so you can't go wrong with it, really. All right, so that's what I would recommend on that, to control or fund your day trading accounts with prop firm money, so to speak. All right, what else can I say? All right, if we look at any stocks, and also don't forget, I'm going to give you an analysis on all the markets here. Realize that it's my opinion based off my trading tools that I've developed, and always run that information by your financial advisor. Okay, that's really important to be sure what I suggest here is suitable for you, because I don't know your personal situation. Okay, so that's important. All right, this I tie in with risk control, and this is what I think is the best prop firm out there. It's called the Apex Trading Funding Firm, and they've been around the longest, and they actually do payouts. For example, it's even higher numbers now because the screenshot's a couple weeks old. But if you look on the numbers there, the average monthly compensation to customers since January of 2023, $11 million. Total compensation to customers since 2022, $182 million. Total compensation to customers in the last 90 days, $70 million. And there's many people getting very large payouts. So it's doable, all right? And I wanted to kind of share our results from July 9th, which was yesterday, trading the prop firms. And, not every day is going to be probably as good as this one, obviously. And past performance doesn't guarantee future performance. but this was results from our day trading room and a little bit after the day trading room as well. And so it is possible, but it takes a lot of work. You got to work at it. We're going to dedicate in October, we're going to do a tutorial here in Tucson, Arizona, where we're going to focus on, have a full day where we're going to focus on trading prop firms. And we're going to cover the ins and outs of how to get qualified, what strategies to use, and the rules and regulations. And then we're going to actually day trade some prop accounts as well. So you kind of want to keep, we're going to announce that. It's going to be in October sometime. I'm not exactly sure when. We're kind of, getting our, we'll probably announce it next month at some point. But I want you to keep that in mind. I'm going to put up a link if you guys are interested in this at all, where you can actually sign up for a prop firm and you can get some money off on that. So I put the link up in the comments area. Here, I'll flash a banner up. Let's see how this works here. I'll flash a banner up for a moment here where you can also see it. So that's available for you, and it's a great way if you're interested in day trading to get into the markets with low risk, okay? So keep that in mind. And you get data, so it's pretty cool. All right, books on money management. We use money management when we day trade too. It's all a matter of your win percentages and your average wins versus your average losses. So we go into great detail on our money management books. Also, too, my newest book called The Art of Trading on the Far Right, all right, is a Wiley released book, and it's done. We finished it. It's going to be about 500 pages, give or take, a couple hundred, depending on how they lay it out, I guess. But it's pretty intense, okay? It's going to be, I think, the best book I've ever written. And it's a piggyback book on my original release back in 2008 on The Art of Trading. All right, software tools that we use, of course, is the ART, OWL, PTF, TLM, and ERI. We use the scanners. We use also risk control software, all available on our website. I'm going to put a link up for both the books and the trading software on the recording so you can access those with a link. All right, so we got today, July 10th, we got NBA mortgage apps coming out. We got Jerome Powell speaks at 10 a.m., wholesale inventories. This is all Eastern time, so this is pretty much has-been stuff. Petroleum status report. And the markets are kind of up today, about 80 points. So I think, things are looking pretty good. Not surprising to me because we had some breakouts on the chart. All right, for Thursday, July 11th, we got CPI coming out, jobless claims, natural gas, a bunch of 10-year announcements, bills and stuff, and Treasury statement and Fed balance sheet at 4:30. All right, July 12th, we got PPI. That's a Friday, of course, consumer sentiment, and the weekly Baker Hughes rig count. All right, so that's kind of where we stand on announcements. All right, so there's my target zone on the daily chart up here, and that's sitting between 40,200 roughly and 47,300. And I think we're kind of going to make a break for that. I've got some support levels on here in case it deteriorates. Something can always come out of left field. This is why we use risk control. No matter how sure, quote unquote, we are on our forecast or where we think the markets or our trades or anything like that, there's no guarantees. You have to protect your downside all the time. That's the difference between a really good trader and a not so good one, right? Is the risk control. So these support levels that I've got on the chart here, if we start taking these out, that's not a good sign. All right. So what I think is going to happen, though, my forecast is, we could jiggle and jaggle, but I think we're going to get our way up to this wave 5 target zone sometime this summer. And I would think probably maintain it through maybe the election. And then after that, we could see some serious selling coming in. So I'm kind of thinking the Fed might cut rates again in September, again, trying to fuel this market, kick the can down the road a little further past the election for stability. And then after that, we'll see what happens. Some people think we'll get 2 rate cuts. Not so sure about that. I'm pretty sure of one, but we'll see. Okay. I don't think inflation is really quite under control yet. And I think even if they give us one rate cut in September, not so sure they should. Okay. But I'll say that. But we'll see what happens with that. So in any case, I do think we'll get there. That is a wave 5 target zone based all the way back on a bull run that started in 2009. So that is a significant target zone. And if the selling comes in after we reach that target zone, then we're going to, again, keep an eye on support levels. We may have some new ones by then. But when we start taking these out, all right, then we're in a bear market. And I think that bear market's going to last a year and a half or so. So I think, we've been anticipating a bear market for the last 2 years. The market just keeps going higher and higher. So you definitely got to follow the market, right? The trend is always right, not your forecast. But the idea is that we do have a roadmap of where we think things are going. And price has got to verify that roadmap. So if we get into this target zone and we see some intense selling and we start taking out this support level, then that's a warning shot over the bow. This one is a worser scenario. That's a word, worser. And then this one down here, all right, is a confirmation of a bear market. So that's kind of how we do it. So that way we're always following the market. And if we get into this target zone even more, we'll have some more support levels that we'll keep an eye on. And, we could go up to 47,000 and then sell off, or we could go right into this level, right around 41 or 40, and then sell off. So we're never sure exactly when the markets will top, but we'll follow them up and see how high they go. So that's kind of the deal behind that. Okay. All right. So that is that. And then also too, I want to look at the 60-minute chart, because we had a breakout on Friday of last week. This was done on Sunday, of that bullish pennant. And this is why I think we're kind of at this point going to head up to that target zone. I was looking to see if we were going to get a breakout, and we got it last Friday, and markets seem to be creeping up now. So I think we're probably going to zig and zag until we get into that target. All our indicators at the bottom, like the PTF, which has a 75% probability, is all pointing to more upside potential here. Okay. So, in other words, this is saying we'll take out this high here at 39.6, and the market's at 39.384. So, it's kind of on its way. So I think probably, we're going to have a bullish time of it for a while. All right. And, if you look at the S&P and even the NASDAQ, we're kind of, been marching up pretty substantially on those markets, more so than on the Dow. But we have not hit their target zones. Now, the target zone for the S&P 500 is 56.55 to 60.89. All right. And we're sitting as of Sunday around 55.66. And it's currently at 55.98. All right. So it is working its way up there. And the same thing, that's a major wave 5 target up there. So when we see intense selling coming back off that, then we got to prepare for a bear market in the S&P as well. And the NASDAQ is no different. Okay. NASDAQ currently right now is at 18,524. All right. So we're up another couple hundred points. And check out where that target is, 18,529. Amazing, right? So those are all fib targets based off the Elliott Wave count. And so anyway, that's the deal on that. And if you want to learn more about how I put all this together, that's what my books are for. Okay. And also the tutorial coming up in October. So, markets, I think, are going to go ahead and go in there now into those target zones and maybe stay there for a while. All right. And then let's see what happens towards the end of the year, especially after the election. Now, again, anything could happen. We could hit that target. We're like 20 points away. And you could have something come out of left field and cause the market to go into a bear market. So when we get to these levels, okay, it's a teetering time. All right. We could teeter higher. We could teeter lower. So keep your stops in place. Please meet with your financial advisor And if you have long-term portfolio and you're worried about what's going to happen when the bear market comes, get with them, talk with them, because there's many strategies you can employ. There's also tax considerations you have to take into account. If you have a lot of your stuff in IRAs, you're okay tax-wise, all right? But your IRA will take a hit if you don't protect it in some form or fashion. And there are inverse ETFs that you can use to hedge a bear market. Okay, so talk with them, get with them, have a plan, keep following the market up, enjoy the profits, have stops on trades fairly close. All right, and even long-term stops are good to have in case you get a reversal. All right, so keep that in mind. All right, Bitcoin. We're going to take a look at the live chart, getting a little bit of bullishness coming back into Bitcoin. What I'm seeing in Bitcoin now is a red PTF that formed, okay? And I got to take a look at that live to see what the deal is on that, because that may indicate that we don't have a bottom yet. We did hit the target. There it is, okay? So we did hit the target. It's amazing how those fib targets work so well. But we did hit the target, and that target is 53,280 down to 46,59. I don't think the bottom's in, okay? We're going to take a look at the live market in a little bit. All right, shifting gears, going into real estate now. All right, here's the Case-Shiller Index versus the CPI. Case-Shiller is in red, all right? CPI down here in black. CPI is the Consumer Price Index, which measures inflation minus certain things, commodities like energy and stuff like that. Case-Shiller is the average residential home prices in the United States, not commercial, okay? Now, this goes back 50 years, and notice that the housing prices represented by the Case-Shiller Index red line has always been above the CPI. So that makes real estate a good investment as well as a necessary place to live. So that's why home ownership has been the staple, especially of the middle class, to gain wealth for retirement. There's also stocks, there's also IRAs, but there's also the place you live in. And so you're kind of getting a double benefit, and even a triple benefit owning real estate, because the tax you get to write off the mortgage interest. All right, so there you have it. Now, the bad thing is of course bubbles, whether it's stock market or real estate. Do I think we're in a stock market bubble? Yes, and I think the target zone that we're shooting for is going to be some of the top level prices in the bubble for the stock market. In real estate, let's take a look at this. So this was the financial crisis, okay, back in 2006 it started. And this is where we are today. Just very quickly, if you like the visuals, all right, bubbles happen when they get away from their norms. And in real estate, the norm is when it starts to rise dramatically away from the CPI, all right? And we had a rise here and a correction. Now look where we are, okay? Double the distance. That's a 2 times distance. And that accounts for the CPI moving up due to inflation recently over the last 4 years, okay? So, but real estate's gone up. So, do you think that the Case-Shiller Index versus the CPI situation is different this time than it ever has been in the last 50 years? I don't. I just think right now we're in a super bubble in housing, and it's going to correct. And when it does, it's going to be some correction, like 50%, maybe 60, anywhere from 40 to 60. Let's say that. So that ain't a pretty picture, okay? And the only reason why it hasn't happened now is simply because the demand's not there, and the reason for selling is not there, even though the inventory has increased somewhat. And when real sales actually happen, they are discounting their prices. That's what the data is showing. So what would make this thing bust? A recession, people losing their jobs and having to sell, even if they don't want to, getting rid of those low rate mortgages, because if they lose their job, they lost their job. All right, so here's an example. I wanted to add this in. Bubbles are a very interesting thing. They can last a long time. And back in the financial crisis in 2006 to 2000, actually it started peaking in 2006. But, it can last a couple of years before they burst. So the fact that people may say, well, why hasn't it burst already if it's in a bubble? Because bubbles can take time before they burst, right? And then, when they do burst, they can last a while. So real estate's, the problem with real estate is liquidity, right? So when the bubble bursts, all right, even if you want out, you may not be able to get out if there's no buyers. And so that's always a problem. And then people have to drop home prices dramatically to get any buyers that are out there interested. And so, it's a process. Usually real estate doesn't fall out of bed like the stock market does sometimes. It's a slower progression because it's not an instantaneous market like the stock market and so forth. So when things sell off, it takes a long time. So you can see here, what it took about 4 or 5 years for this thing to reach the 2012 bottom. And then you had a recovery. So the bubble can last a while, but the actual bust and the selling decline lasts even longer. So I kind of thought this was kind of a cool graph to illustrate that point. All right, so I've showed this before, but inventory's increased, and this is as of the last. This chart's getting kind of old, so this was May, but even the June one is showing that we're having increases in inventory. But again, the demand's not there. Housing is so high right now, and interest rates are high. Interest rates, are they high? Kind of, but not really historically. They just were so darn low for a while due to a variety of factors that people got used to it. So in my lifetime, I can remember back, when was it? In the late 80s, or I guess in the early 90s. I don't want to show my age too much, but back in there, I remember, interest rates around 10%. All right. So if you go back far enough, all right, what we had of a zero interest rate situation is not normal. Okay. So 6 or 7% and even 8% may be high for people that are only used to doing transactions requiring loans for maybe the last, 20 years, 25 years, maybe 20 years, probably. All right. So, a 6 or an 8% interest rate range to them is like, oh my gosh. So it's a psychological thing. All right. So it's holding people back. And then, of course, you have home prices so high, you got the double whammy going on there, right? So here's a little bit more of a recent inventory. You can see it creeping up, okay, still. All right, so the inventory is increasing. A higher inventory, of course, means lower prices at some point. And, of course, there's some states that are always a little different, all right? California, even New York, all right? The big city areas, those are the ones with the highest prices. And, certain towns like even San Diego had incredible appreciation last year in terms of on the books, I'll say. However, when people actually go to sell, they're having to discount the prices. And in California, to see any more substantial discounting, we need listings to increase 20 to 30% more, simply because of the fact that the inventory is so low there. Okay, so that's kind of interesting to note. This is kind of interesting, percent of properties with recent price reductions. All right, so we have the different years outlined by the different lines here. Okay, you have 2023, I marked with an arrow there. But in 2024, which is above it, okay, 36.4%. So what this is basically saying is 36.4% of the people are having to drop prices in order to make sales. That's what that's saying. All right. Compare that with, 4 years ago during the go-go years where people were overbidding. And that's what these lines are showing. Okay. So the actual transactions that are being done today, and this is an average, okay, real estate's local, so this is an average, are 36.4% are having to come down on their prices to actually make the transactions. You don't hear about that. in the news. All you hear about is inflated prices, but this is what the data is showing. All right, 30-year fixed is at 7.08 roughly. All right, 15 is at 6.53. The arms are at 6.52, and the jumbos are at 7.14. All right, on the arms, there's a lot of talk out there that the government is getting ready to back the arms for second mortgages. So in other words, you can get a second mortgage on your home. These are called the old HELOCs, and they kind of weren't supporting the HELOCs after the financial crisis because that's what got everybody into trouble. You know, there were no income checks. They were easy to get. Wall Street was packaging these things into mortgage-backed securities that they could sell and so forth and so on. But the bottom line here is that now people's credit cards debt is so high that the government's concerned, and they're defaulting, that the government's concerned that they have to figure out some plan in order to help out everybody that's having trouble due to inflation and higher rates. So the arms are their way in which they're going to let people tap into the equity of their home, because don't forget the equities are up right now. So to pay off their credit cards, be careful of that. Okay, be careful, because if prices come down, your house will be underwater and you'll have all sorts of problems. And don't forget, you still have to make those payments. I wouldn't do it. I'd cut up the credit cards first, but it's a possibility. All right. All right. Recession. Now, this is kind of an interesting chart on the whole home builder inventory. Notice that every time we got a spike in inventory, a recession followed. That's basically what this is saying. In 2022, we had a spike. And, you know, again, this recession has followed. So spike may not be over right now. We're still in the spiky area, so to speak, in 2024. So very interesting, right? Now, what home builders are doing is they're giving away a lot of incentives. Home builders, the last resort for a home builder is to drop the price. Because once they drop the price, then that's public, okay? Then people know, okay, prices are dropping. I'll underbid, or we'll, you know, make offers when. Builders don't like that, okay? They'd much rather get you to pay the price of the house, because then it looks like the market's robust. Builders do not want any signs that the market, the real estate market's not doing well, because, you know, that's the kiss of death for them. They'd rather offer incentives and keep those sales prices stable to show that the market is good when they're talking to possible clients. But in any case, the more inventory a builder has, because sales are not happening, all right, like they'd like them to, and the more incentives they try to do to make it happen, but the inventory increases anyway, then you've got a problem. People aren't buying homes, and it usually precedes a recession. That's what this chart is showing. All right, so a little summary on this stuff here. I will go over that new schedule in just a minute, okay? The growth rate for asking prices has stalled since February. This is likely due to significant rise in housing supply and elevated mortgage rates. All right, inventory increased by 36% a few weeks ago. This is more than a week old. All right, and that's the biggest one since April 2023. This is caused by a drop in home sales and a rise in new listings from the previous year. So inventory's gone up. All right, and that's what that's saying. All right, there's still 33% fewer homes for sale in the U.S. compared to the same period in 2019. So the inventory, even though it's increased, is not increased to what it needs to be for prices to come down. All right, so that's kind of what that's saying. 30-year rates are below the October 23 peak of 8%, but housing affordability is very close to record lows due to the double whammy, like I said before, record home prices and elevated rates. All right, mortgage industry is hurting big time. I feel for you guys in the mortgage industry and even realtors. The problem is the transactions are not there. Okay, everybody thinks, oh, real estate's doing great because prices are so high, but transactions are not occurring at the levels that folks in the business need it in order to do well. So 13% year over year, ending the 21st, apps are down. Pending home sales fell by 7% in May to a record low, and we're getting past the prime selling season now. All right. So once we're finished with August, that's pretty much it. And it ain't looking too good, as they say. All right. Let's see. Okay. New home sales decreased by a whopping 17%. All right. Increasing that inventory on that chart I showed you before. All right. Home builders offering closing cost credits, lower mortgage rates, and free builder upgrades, but it didn't help boost sales. Increase in inventory. Previous occurs before a recession, like that chart I showed you. The drop in sales for new houses is staggering, given that there's more new homes for sale this May than any other month going back to February 2008. All right, 78% of the homeowners who have a mortgage are locked into interest rates below 5%. All right, that has been limiting the amount of people listing their homes for sale and thus keeping housing inventory well below the 2019 levels. New listings are higher than last year, but we're only seeing single-digit gains for the past couple of months, and it will get worse now that summer is getting more mature and the prime. We're really getting past the prime selling season. Let's face it. All right, and let's watch the rate of increase due to inventory in the coming months. So we'll see what happens. You may get a little spike in inventory as people panic that they're not selling their home during the prime selling season. All right. Overall, asking prices are high but flat. All right. Inventory is up, but homes are sitting on the market longer, and we're seeing more price reductions. Okay. Now, all of this, okay, indicates a softening market, but not a bubble burst. All right. But it could look a lot worse if we don't get any more decreases in mortgage rates. And I don't think we're going to. Maybe one. I call it one for the election. All right. And also, too, if you get a recession, all bets are off. All right. Here's a mortgage apps, just to, I guess, rub it in a little bit more how bad the transactional business is in both sales and mortgages. And we covered that. And here's just, I'm about to wrap it up here, but here is a inventory for sales compared to pre-pandemic levels. And the inventory, the higher the negative number, all right, the higher I will say the appreciation, so to speak, in prices. So Texas has been hurting lately. You probably heard Texas prices coming down in Texas. Well, that's because their inventory's up. California's down. Look at Maine, minus 60, 47. All the big cities, all right, as long as the inventory is remaining low, then you will see housing remain high. Why are they low around the big cities? Primarily because that's where most of the employment is. And so people don't feel the need to get rid of their low interest rate mortgage as long as their jobs are stable. And big cities offer the most stable jobs. So if a recession hits, again, that goes out the window. And it's looking to me more and more like we're heading towards that way, especially since we're at a stock market bubble too. All right, just a wrap up here. Data since 2020, food prices are up 20%, gas prices 47%, mortgage rates up 160%, home insurance rates 60%. And that's another problem is the home insurance. California is having a battle with State Farm on whether State Farm is like, we're raising prices, and if you don't let us, we're out of here. All right. So, home insurance is a big problem in California, especially, but across the country, it's gone up. Car insurance, 125, it's gone up. Real wages are down 2.24%. That's not good. 49% live paycheck to paycheck, and 50% have less than 500 in savings. All right. So let me go back here real quick. Try not to give you a headache. I'm going too fast here. But let me go back. Gene wants me to make sure everybody saw that. Okay. New market review schedule. So after today, we will not be here next week. Okay. We will be here the first Wednesday of every month. So after today, the next one is August 7th. Okay. August 7th. And in August at some point as well, we're going to announce our live tutorial that will be done here in Tucson. The weather will be gorgeous in Tucson then. No more heat, we start getting into the winter months, but the fall in October is ideal. So bring your golf clubs if you come out here. But in any case, the tutorial is going to focus not only on the art system, but on how to navigate and get funded in a prop firm. We're going to focus a lot of time on that and some setups that I look for as well. So that's going to be in the tutorial here in Tucson. Okay, so we'll let you know on that. All right. Before I go, one quick look, real quick at, I want to take a look at Bitcoin. So Bitcoin here, here's your red PTF, which is causing me concern. All right, it's calling for a move back down here. I guess here's the move that was represented way over here. So it's calling for a low over here. So I don't think we're going to climb straight up. We may go up a little further. We could go up into the 60s, but then we may see a pullback again. So I'm not quite, as long as that stays red, that PTF, I'm not buying more Bitcoin yet. Okay, so that's kind of where I'm at. That blue line running here is just a 200-day moving average, okay? And it was kind of interesting that it sat right on the doorstep of going into that fib target zone. All right, well, that's it for today, all right? You guys have a great one. We'll see you back here. Of course, let me bring this back. We'll see you back here on Wednesday, August 7th, okay? We'll be live here once again. And again, if you want a weekly update, we have something called More, and I'll put that in the recording that you can click on. So if you want to subscribe to our More subscription and get updates every Sunday before the market week, then you can have that as an option, okay? Otherwise, we'll do these freebies once a month, okay? All right, and as Jean says, here, let me pop her little thing up here. Give us a like today, and thanks so much. All right, guys, have a good one. We'll see you August 7th. Take care. I'll put a little music on.